Imagine watching your portfolio surge, feeling the thrill, only to sell early and see it climb another 20%, 50%, or even 100% without you. This isn't just bad luck, it's a deeply ingrained psychological trap. Many retail investors exit winning positions too soon. Studies show the average holding period for stocks in the S&P 500 has shrunk from 8 years in the 1960s to just 5.5 months today. This short-term focus costs billions. This isn't about being unlucky. It's about the very human fear of losing what you've gained, what psychologists call disposition effect. You're eager to lock in small profits, but reluctant to cut losses. This leads to what Wall Street calls paper hands investors who fold at the first sign of profit or volatility. They prioritize immediate, often modest, gains over the exponential growth potential of holding long-term. Consider Apple stock. A $10,000 investment in 2000 would be worth over $4 billion today, but only if you held through the dot-com bust, the 2008 crisis, and countless corrections. Most sold long ago. The fear of giving back profits is a powerful emotional trigger. You see your investment up 15%, and your brain screams, "Take it? Don't let it disappear." This overrides rational analysis of future potential. This fear blinds investors to the true opportunity cost of selling. Every dollar you pull out early is a dollar that can't compound over decades, potentially costing you hundreds of thousands in future wealth. The 24/7 news cycle and social media amplify this. Every dip is a crash, every correction a bear market. This constant noise fuels panic, pushing you to make emotional decisions instead of strategic ones. True wealth isn't built on quick flips. It's grown through patience, like a farmer tending a field. You plant the seed, nurture it, and harvest when it's fully mature, not at the first sprout. The average millionaire holds their winning investments for decades, not months. They understand that a short-term dip is often just noise in a long-term growth story, not a reason to abandon ship. Your conviction in an investment should stem from thorough research, not market sentiment. Understand the company's fundamentals, its competitive advantage, and its long-term growth trajectory. As legendary investor Peter Lynch said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Patience is a virtue on Wall Street. But what if it crashes? This what if paralyzes many. Instead of selling everything, consider a balanced approach. Rebalance your portfolio, trim overvalued positions, but don't abandon your long-term winners. Effective risk management isn't about avoiding all risk. It's about managing it so you can stay invested longer. Diversification, position sizing, and proper asset allocation are your allies. Overcoming the urge to sell too soon is a battle against your own instincts. It requires discipline, a long-term vision, and a deep understanding that the market rewards patience, not panic. This is just the beginning. While patience is crucial, its true power lies in time in the market, not timing the market. Data from S&P Global shows that missing just the 10 best performing days over the last 20 years could slash your returns by over 50%. Consider this, a hypothetical $10,000 invested in the S&P 500 from 2003 to 2023 would have grown to over $60,000. But if you missed just the 10 best days, that same investment would be closer to $25,000. That's the real cost of selling too soon. This urge to sell prematurely often stems from loss aversion, the psychological bias where the pain of a loss feels twice as strong as the pleasure of an equivalent gain. When markets dip, our brains scream, "Cut your losses," triggering irrational decisions. To counter loss aversion, adopt a disciplined rebalancing strategy. Annually or quarterly, adjust your portfolio back to target allocations. This forces you to buy low assets that have dipped and sell high assets that have soared, systematically removing emotion. The magic of compounding is often underestimated. Albert Einstein reportedly called it the eighth wonder of the world. Even small, consistent returns like the S&P 500's historical average of 10% annually can create immense wealth over decades. If you let them. Warren Buffett famously said, "Our favorite holding period is forever." This isn't just a catchy phrase, it's a philosophy. He focuses on owning great businesses, not trading stocks. His billions prove that conviction in quality, held for decades, beats short-term speculation. Market corrections are not anomalies. They are a normal, healthy part of economic cycles. Since 1950, the S&P 500 has experienced 38 corrections of 10% or more. Every single one has been followed by a recovery and new highs. Don't mistake a dip for a disaster. A well-defined investment plan acts as your personal guardrail. It outlines your goals, risk tolerance, and asset allocation, agreed upon before market turbulence. Sticking to this plan, rather than reacting to headlines, removes emotional impulsivity to sell. Diversification is more than just a buzzword, it's a critical risk management tool. By spreading your investments across different asset classes and sectors, you reduce the impact of any single underperforming asset. This mitigates panic and the impulse to sell everything. In today's 24/7 news cycle, market noise is constant. Daily headlines, social media chatter, and pundit predictions can easily sway sentiment. Learn to filter this noise and focus on fundamental economic data and the long-term prospects of your investments. Stay informed, not influenced. Selling too soon often incurs a hidden cost, the opportunity cost. It's not just about the money you lost, but the future gains you missed out on . If you sell a promising tech stock today, you might forego years of exponential growth, impacting your long-term wealth goals. Dollar cost averaging (DCA) is a powerful antidote to emotional timing. By investing a fixed amount regularly, regardless of market fluctuations, you automatically buy more shares when prices are low and fewer when prices are high. It smooths out volatility and reduces the temptation to react. Continuous financial education is your best defense against market noise and emotional pitfalls. The more you understand economic principles, company fundamentals, and behavioral biases, the less likely you are to panic and sell at the wrong time. Knowledge is your ultimate edge. Setting realistic expectations for returns is vital. The market doesn't guarantee 20% annual gains every year. Understand that long-term averages, like the S&P 500's 10-12%, are built over decades. Unrealistic expectations lead to disappointment and the hasty impulse to sell winners prematurely. Finally, a robust emergency fund and solid personal finance foundation are non-negotiable. Knowing you have cash reserves for unexpected life events prevents you from being forced to sell investments prematurely, especially during market downturns. This stability empowers long-term conviction.